If you've been paying any attention to your stock portfolio, you've noticed a dramatic turn down. And that's because we are inching towards a bear market, and in some cases, we're already there. So today I'm going to be talking about what a bear market is, what you can do to protect your finances, and how my current portfolio is holding up. Hi everyone, this is Camilla the Focused Spender, and welcome to my channel where I teach you how to get out of debt, save more money, and invest so that you can build wealth and leave a lasting legacy. So what exactly is a bear market? Well, a bear market is when a stock index or even individual stocks fall below 20% from a recent high over a sustained period of time. When we think about stock indexes, we're thinking about the S&P 500, we're thinking about the NASDAQ. And the NASDAQ is already in a bear market. So the NASDAQ is tech heavy. And as you might know, many of these tech companies are hurting right now. So when we're thinking about Amazon, when we're thinking about Netflix, when we're thinking about Facebook, companies that for years and years, whenever you saw it, it was like you have to have that in your portfolio, you need to just buy. But these companies are not doing as well as they have been in the past. Revenue is down, consumer trust is low, especially when you think about something like Facebook. People are leaving Facebook in droves, which is hurting the company. So now when you think about NASDAQ, because they have so many tech companies within this index, you can tell why they are in a bear market. Now, the S&P 500 was in the news this week because it was inching towards a bear market. And in fact, on Friday, it hit bear market territory, but it ended up ending the day a little bit higher so that it's not in a bear market. But the S&P 500 is very important because within that index is 500 of the US's largest company, and it really is a reflection of our economy. So if the S&P is doing poorly, then guess what? The US economy is doing poorly as well. So that is the reason why it's such a big deal. And the other reason why your portfolio is probably dipping pretty low right now. The good news is that bear markets don't last forever. They average about 15 months. So right now we could be out of this bear market in 2 months. We could be out of this bear market in a year. We can be out of this bear market in a year and a half. Either way, we're going to come out on the other side of it. It's just a matter of how long it takes, but it's not going to be for the rest of our lives. And on average, bear markets lose about 36% of value. So it is significant, but if you don't panic, you should be okay. So how do we get into this bear market territory? There are a number of factors that are leading us to the point we're at right now. There's rising inflation, there's the war in Ukraine, there's supply chain shortages in China due to COVID. There's so many factors that are really turning the knob on our economy in the wrong direction. And so I cannot say that, if we just fix this one thing here, then everything is better. The market needs some time to do an overall correction before we get out of this situation that we're in. But it is going to take some time. Now, more importantly, how can you protect your finances in a situation like this? The most important thing I want to say is you want to avoid making any decisions on emotion. So you want to have your financial plan that you are rocking with and just stick to it. Me personally, I have my 401k that I invest in every time I get paid. I invest in my IRA every time I get paid. I invest in Betterment, M1 Finance. I'm going to look to see if I need to switch up any companies in my M1 Finance, but everything else is going to stay the same because it's part of my plan. Meaning you have to have an investment plan that you're willing to stick with come hell or high water. You don't want to say, well, today I'm going to invest in this one stock. Oh, the stock is down? Okay, I'm going to sell it and put my money there because I heard about something on TikTok. Oh, that's not doing well? Okay, let me sell that. No, you don't want to do that because you're going to just lose money. And that's it. You're just going to lose money. So you want to make sure that you're avoiding making any decisions on emotions, and whatever plan you have for your investments, just stick to it. Even if you do have to make tweaks here or there, you don't want to make some dramatic switch. And you also don't want to do some massive sell-off because once you sell your stocks, you are locking in the losses. You have officially lost money. You have not officially lost money until you sell your stocks. In March of 2020, I remember being on a Facebook group or looking at a forum, and someone commented on the fact that they had just sold off their $100,000 stock portfolio. So if you remember from March 2020, we were in this situation again where there was a huge dip in the stock market. Now, if this person had just waited a month, 6 weeks, their portfolio would have rebounded and grown by 20 something percent. Like, the fact that they sold it off made me think, This is not what you want to do. They're putting on the internet. People are like, oh yeah, I'm going to do the same thing as well. No, don't do that. Unless they were like retiring the next day because they were 95, there was really no reason for them to just sell off their stocks. You have to make sure that you're not doing something drastic like selling off your entire stock portfolio. Other things you can do to help bolster your portfolio is to start looking at companies or ETFs that really focus on personal care, necessities, food, etc. Things that people have to purchase whether or not the economy is doing well or not. In a recent video, I talked about my M1 finance portfolio, and I noticed that the stocks that were doing the best were my investments in oil companies. So ExxonMobil, Sunoco, those stocks were doing really well because at the end of the day, even though gas prices are high, people have to buy gas because they have to go to work, they have to travel. So you really want to focus on companies that are proven to do well when the stock market goes down. And you also want to think about dividend stocks or dividend ETFs so that even though you don't have stocks that are growing in value, you're able to invest in stocks that are still paying you out dividends. And that way your portfolio will still grow because you're buying more and more shares of a certain company or into your ETF. So let's switch gears and talk about how my portfolio is doing. When we look at just my investments and we look at it for the past year, the highest point my investments were at was $416,000. And when we look at it right now, it is $366,000. So when I did the math, that was a difference of $50,000, meaning that my portfolio dropped by $50,000 from its highest point this year. And that is a loss of 12%. So it's not great. It could be a lot worse. I'm not going to cry over this money because I know that as long as I stay the course, it's going to rebound. So for me, like I said earlier, I'm just going to stick to my current investment strategy. I might look into my actual ETFs just to see if there's something else I could be doing differently, but I'm not going to do anything drastic. I'm not going to sell anything off. I'm not going to stop investing. I'm going to keep investing while prices are low, even if it's low for the next year and a half, so that once it rebounds, it will rebound in a really, really healthy way. And that's something that I suggest you do the same as well. And so let me know in the comments how you're feeling about the current state of our economy, what you're doing differently, if anything. I hope you enjoyed this video. Please be sure to share it with your friends, and I will see you next time. Thanks. Bye-bye.